The only publicly traded bank which focused on tech startup in US has collapsed. Yes, I am talking about SVB. And in this video, we are going to see what has happened, why it has happened, what are the impact, probably who can prevent all this kind of disaster. So stay tuned till the end, and if you like, please don't forget to subscribe. SVB, Silicon Valley Bank. This was a publicly traded bank which primarily focused on startups, tech startups, venture capitalists, those who are lending money in the early stages of the company. So especially after 2019, entire startup ecosystem was on boom. This stood as a primary beneficiaries. If you look at the deposits that they could attract from 2019 to 2022, that had gone up from 60 to 193 billions. This will tell you what huge influx that they have received. They had cash-rich customers, everything was going well. Now they have decided that let's keep minimum level of deposits to manage any kind of liquidity issues and majorly investment. And let's invest more in the long-term bonds or the mortgage-backed securities. I have to draw your attention to one more point here. For any banking sector, they have to maintain a healthy balance between profitability and liquidity. It is true in individual's case also. Say you have 10 lakhs of rupees. You have three options. One option, you take that 10 lakhs and invest everything in the stock market. Maybe it is a great return for you, but risk is also higher. Second, you don't want any risk, you are keeping everything in saving banks account. Now it can be completely safe, highly liquid, but rate of return is also lower. Third option, you take out maybe 3 to 4 lakhs and keep it for emergency purpose in SB account, and rest of the amount you are going to invest in the stock market. So ideally, third point should be, giving you the point of balance here. So it is true in the case of bank also. But what SVB did, they decided that majority of our investment will be in the long-term bonds. Maybe this strategy worked well for them before Fed started interest rate hike. For a banking industry, they should have had some robust risk management system where they analyze what are the risks which stems from the macroeconomic conditions and predict it, be able to foresee what can go wrong and how it can impact our business model. Do a pestle analysis, political, economical, social analysis, and then find out how that can damage the business model that we are currently having. That should have been done, which was clearly a failure in case of SVB. They could not foresee the interest rate hike by Fed, and they ended up investing everything in the long-term bond. There is no diversification, concentrated portfolio. Now let us see, when Federal Reserve in US started raising the interest rate in order to tame the inflation, what has happened? It created a cash crunch situation in the whole ecosystem. How did this impact SVB? In two ways. So first, its main portfolio of the asset is in the long-term bond. Again, let me give you an example here. Tomorrow if the government comes and says, hey, I am going to give you 3 to 4x return on the short-term debt securities, will you invest in the long-term bond which I am going to issue? No, right? Because you are going to get 2 to 3x more literally at no risk, zero risk. So there is no value for long-term bonds when there is an interest rate hike done by the government. That is the reason the yield of the bond goes on diminishing. The value of the bond goes on diminishing. Typical case had happened in case of SVB, and it ended up losing majority of the asset value after Fed started increasing the interest rate. Now, the second point is, the major customers were VCs and the tech startups who already were suffering because of the recession environment persisted there. So they had no other option except coming to the bank and withdrawing the deposits that they had made, because they have to meet their cash requirement at the end. Look at this picture. In this balance sheet of SVB, there is an item called held till maturity. These are the securities which company will purchase and intends to hold till maturity. This, in case of SVB, is about the bonds, long-term bonds, where it has done major investment. The cost of acquisition, as you can see, is 91 billion, but the fair value is around 76 billion. That means there is a notional loss of around 15 billion. It may not be recognized, it need not be recognized as per accounting standard, because by the definition itself, this is an asset which you intend to hold till maturity. So whatever happens in between during the duration of your holding, it's okay. But it also says that the loss started. There is something happening in the macroeconomic environment which is acting against you. Which is that? Federal Reserve's interest rate hike. There is no demand for your bond portfolio. People are preferring to buy the short-term securities which are issued by the government. Now the picture is clear, right? Bank has made an investment in the asset class which started losing its value. And it is not even generating enough investment income. If you see, it was giving only 1.79% of interest income against 3.79% of the income which 10 years US Treasury bonds generated. So this gave a total sense to other investors that, this bank is not performing well. Now on other hand, there are people who have deposited, started lining up and asking back the deposits because they are the startups, they are cash starved and they have to do this to meet their cash requirement. Now the pressure started mounting on the company. So now SVB decides, let us sell the bond portfolio of $21 billion and recognize a loss of $1.8 billion because they have to get the cash to honor the commitments, right? But this was not well received by the stakeholders. They started suspecting whether the capital is adequate with the bank, why they are recognizing such huge loss. So within few hours, the bank ended up losing nearly 42 billions of deposits. Now they started witnessing exodus of deposits. They had to do something again to fix the hole. So they go and say, we are going to sell equity now and raise $2.25 billion. This creates total hysteria everywhere in the market. And in banking, only two things matters: cash and confidence. If you are losing this in the market, you are totally out of the game. Now let us see what would be the impact on the financial market and the startup world. Now, talking about the financial market in India, this is heavily monitored, controlled, effectively managed by Reserve Bank of India. Our equity market, capital market showed great resilience when there was a turmoil in Western markets. So obviously, there will be limited impact on Indian banking industry. Secondly, talking about the startup ecosystem, in the website of SVB, it mentions that 44% of VC, venture capitalist backed startups in healthcare and tech have funding from that. And as per FDIC data, nearly 89% of the deposits are not at all insured. What does that mean? Till Monday morning, that is March 13th, an insured depositor can withdraw up to $250,000 only. What about the uninsured and beyond this limit? They have to take the letter of receivership and wait till the liquidation proceedings are over and the proceeds realized from the sale of the asset is distributed among them. Now, if this is the case, nearly 40 VC-backed startups from India have kept deposits there, which ranges from $250,000 to $100,000 US. So there will be bloodbath probably in startup world. Lastly, who has answers to all this? Who could have probably prevented all this disaster? The real villain is not the company. See, I agree that Silicon Valley Bank should have had some kind of robust risk management system where they do their own SWOT analysis and the pestle analysis, understand the risk which stems from the environment in which they are functioning and how that is going to impact their business model. That was their failure. But the real villain is Fed. The Federal Reserve in US kept always hiking the interest rate without even understanding what is the real cause. There is lot of difference when the inflation is stemming from demand side or supply side. See, if it is from demand side, people are on spending spree. That means you have to keep the interest rate high so that there is no much capital available and they spend less, inflation is down. But what about the inflation is from the supply side? There is supply chain disruption, there is shortage of the supply and shortage of the capital to the businesses which are operating. And in this case, if you are again increasing the interest rate, how a business can thrive in an environment? So they effectively ended up creating a situation where there is a big hole. The hole is costing the entire US banking industry 620 billion US dollars. Now tell me, who is actually exposing the vulnerabilities of US banking sector? Share your views in the comment section.